As to this recent reaction, I would say that it is perfectly normal. The excessive speculation, perhaps, which is reflected on the Shanghai Futures Exchange, might be behind this move back. There has been a build-up, if you like, in terms of open interest on COMEX as well. Not excessively so, but taking the managed money portion, if you like, or category, to just slightly more than average levels, if you like. Now, that does imply that if you get just a loss of short-term momentum, then these guys are vulnerable to having stops taken out and encouraged to sell on, because there's a correction. And I mean, they're in there, the business of buy dollars, sell gold, or the other way around. Now, they've been screwed by that relationship actually not working, because both the dollar has risen and also the gold price has risen.
In today's market recap, silver sheds 1.8%, gold down 1% after Fed call. The prices of white and yellow metal retreated on Thursday following the Federal Reserve's two-day policy meeting, during which the officials decided to keep interest rates steady at 5.25% and 5.50%. Fed Chair Jerome Powell underlined that further progress on inflation is not assured, stressing that the central bank will not ease its policy until officials have greater confidence that inflation was moving sustainably down to its 2% objective. The comments appeared to have weakened investors' appetite for safe haven assets, with all eyes on non-farm employment data expected on May 3rd. Market volatility is picking up across the board, especially in the precious metals sector, with wild moves up and down. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications. Also, if you're thinking about adding crypto to your commodities portfolio, check our pinned comment for some massive sign-up bonuses. Enjoy the episode.
There is increased speculation on the Shanghai Futures Exchange, which is one of the things that has certainly contributed to the rise in the value of gold measured in dollars. Now, that speculation, I think, is probably informed by an analysis of actually what the People's Bank is doing. So that speculation, I think, is likely to build up. Now, futures markets don't necessarily lead to demand for physical, but there is a requirement for physical if you get increased open positions in that market. Now, what I mean by that is that we have seen bond yields rise, which, in recent years, recent decades, has been bad for gold. We've seen the dollar rise on trade weighted, which has been bad for gold. And taking particularly those two together, you would think the gold actually would have fallen, but instead it rose as bond yields rose, and it also rose as the dollar rose. So this is a very, very different time, I think, from anything we have seen since those 1970s. Now, principally, the difference between that sort of period following the 1970s and the 1970s was until interest rates were raised to close to 20% by Paul Volcker, there was a fear in the markets that hyperinflation would take place. In other words, the purchasing power of the dollar and other currencies would decline substantially in this it was then a new sort of fiat paradigm, if you like. That was finally broken by the determination of Paul Volcker, as I just said, by raising interest rates. Now, since then, interest rates and bond yields have declined and declined and declined. They've now started rising. The problem with rising interest rates now is that it exposes government debt, it exposes malinvestments, it exposes a lot that's going to go wrong in the world of credit. And principally, when it comes to monetary affairs, there are two worlds. There's the world of money, which legally is gold, and there is all the rest, which is credit. So it's that relationship between gold and credit. So what the gold price has been telling us in recent months is that the fear is now about the future of credit, not interest rates, not the exchange rate of the dollar measured in other fiat currencies, which, of course, is what the trade-weighted index is.
The financial landscape is increasingly turbulent, with experts like Alasdair Macleod believing the crisis will worsen. Recent regional bank failures echo the 1970s financial turmoil, highlighting vulnerabilities in today's economic framework and signaling further instability. Amid this uncertainty, gold and silver markets are behaving unexpectedly. Despite typically suppressing factors like rising bond yields and a strong dollar, gold and silver prices have risen, indicating a unique market scenario and potential shift in investor sentiment. Alasdair Macleod points out that China is strategically reducing its reliance on Western currencies and expanding its gold reserves. This long-term policy aims to shield its economy from external shocks, reshape the global economic order, and assert more control over monetary policy. In contrast, the U.S. faces a looming debt crisis. Rising interest rates and a substantial budget deficit stretch finances thin, worsened by reduced demand for U.S. debt, particularly from China. If not addressed, this could lead to a dangerous debt trap and further destabilize the global economy. Now, we'll show you more clips, but remember to subscribe to the channel so you do not miss out our daily videos. Let's get back into the episode.
So this is fundamentally different. Now, to an extent, it has been led by China. The pace of Chinese buying, not just the central bank, but also other Chinese actors, of physical gold has increased. And indeed, we have seen this extraordinary situation whereby Western ETFs have been declining and feeding gold out, as it were, into Asia. Now, this is an extraordinary situation, because what that again tells us is that we in the West have tended to sell gold while it has been going into new high ground. Now, this is the sort of behavior which is temporary, because there does come a point, I'm just purely talking about psychology now, there does come a point where people sort of turn around and say, oh, hold on a minute, gold is in a bull market, bonds are in a bear market, that makes equities less attractive. The only game in town is gold. Therefore, we should, why is it going up? Perhaps we should buy it, sort of thing. So it's a sort of in-between period, if you like, in terms of the psychology of markets in the West. The fascinating thing about it, however, is what are the Chinese actually doing? And if you look at it from the Chinese central bank's point of view, the People's Bank of China, they have a long-term policy of reducing their dependence on Western currencies. This, after all, was the whole point about trying to set up a new trade settlement currency for BRICS, which was mooted before the Johannesburg meeting in last August. It is also a vowed public policy of the Chinese government, the Saudis now, Russia, Iran, the Shanghai Cooperation Organization, and the extended BRICS organization as well. So what we're looking at is a situation where the two major hegemons, particularly Russia, who's, with Putin had his nose put out of joint by sanctions, currency sanctions, and China, they basically want to do away or lessen their dependence on the dollar. So from the People's Bank's point of view, it would be entirely consistent for them to reduce their holdings in dollars. Now, when you look at that properly, really, it's not so much that they're buying gold, but it's more that they're selling dollars. Now, this adds, and I think that this is something which markets will begin to realize quite quickly, it adds another dimension to the dollar problem. And that is that the largest single identifiable buyer of US treasuries is the Chinese government. And the Chinese government is selling dollars. And if it's selling dollars, it's also selling the underlying assets in which those dollars are invested, which, of course, includes a figure like $775 billion worth of US Treasury debt. So if the Chinese are actually reducing their dollar holdings, then what that means is that they are not going to be participating in the increased financing requirements of the US Treasury with a budget deficit of over $3 trillion to fund. This is going to create a debt crisis for the US Treasury. And those open positions will be reflected two ways. Firstly, in terms of the collateral that's required to back those positions. And the second thing, and the collateral really will be in the banking system, as it were. The second thing is that there is probably, through Globex, Chinese involvement dealing on COMEX, which, again, basically means that the swaps on COMEX will find it extremely difficult to close their positions. So the reverberations of what China is doing, the position that China now finds itself in, are going all the way around the world. And despite the fact that retail interest in America and also in Europe is declining on higher prices, prices are still going to rise.
What do you think of Alasdair take? Will get worse for gold and silver before it gets better? Are you scared of the current market volatility? Post in the comment section your insights and watch this video right here because it's a perfect fit for you. I see you on the other side.